April 3, 2025, will be etched in the annals of financial history as a day of unprecedented market turmoil. Global stock markets witnessed a bloodbath, with indices plummeting at alarming rates. The catalyst? President Trump's unexpected announcement of sweeping new tariffs on imports from numerous countries. This sent shockwaves through the financial world, triggering a mass sell-off that wiped out trillions of dollars in market value. The Dow Jones Industrial Average, a bellwether of American economic health, plummeted by a staggering 3.5%, with futures contracts plunging over 1,200 points even before the opening bell. The technology-heavy Nasdaq Composite suffered an even steeper decline, shedding 5.1% of its value. The S&P 500, a broad measure of the U.S. stock market, wasn't spared either, tumbling by 4.2% and erasing all its gains for the year. This dramatic downturn marked one of the worst trading days in recent memory, evoking fears of a repeat of the 2008 financial crisis. The suddenness and severity of the crash left investors shell-shocked and grasping for answers. Adding to the sense of panic was the precipitous drop in the value of the US dollar. As investors fled riskier assets, the greenback, typically seen as a safe haven during times of uncertainty, weakened against major global currencies. This unexpected turn of events further fueled the sense of unease in the markets, as it signaled a loss of confidence in the US economy. The stock market crash of April 3, 2025, was a stark reminder of the interconnectedness of the global economy, and the profound impact that political decisions can have on financial markets. The immediate trigger for the market meltdown was President Trump's announcement of a new wave of tariffs on imported goods. In a move that stunned economists and policymakers alike, the Trump administration unveiled a complex web of tariffs targeting a wide range of products from key trading partners. These tariffs included a baseline 10% levy on all imported goods, a reciprocal tariff mirroring the duties imposed on U.S. exports by other countries, and specific tariffs aimed at major economies. China, already embroiled in a protracted trade war with the United States, found itself in the crosshairs once again, with tariffs on Chinese goods reaching as high as 54%, including existing tariffs. The European Union, another major trading partner, was hit with a 20% tariff, while Vietnam and Taiwan faced levies of 46% and 32% respectively. The administration argued that these tariffs were necessary to protect American jobs and industries from unfair foreign competition. However, the move was met with widespread condemnation from business leaders and economists, who warned that the tariffs would backfire, leading to higher prices for consumers, job losses, and slower economic growth. The tariffs were seen as a dangerous escalation of protectionist policies that threatened to unravel decades of progress toward free trade and globalization. The shockwaves from the U.S. stock market crash reverberated across the globe, sending other major indices into a tailspin. In Europe, the FTSE 100 in the United Kingdom shed 3.8%, while Germany's DAX index tumbled by a hefty 4.5%. Asian markets were not spared either, with Japan's Nikkei 225 index sliding 3.9%, and the Shanghai Composite in China falling 3.2%. The synchronized nature of the global market decline underscored the interconnectedness of the global economy, and the fact that economic woes in one part of the world are quickly transmitted to others. Adding to the turmoil was the sharp depreciation of the US dollar against other major currencies. The euro, the Japanese yen, and the Swiss franc all gained ground against the greenback as investors sought refuge in perceived safe haven currencies. The dollar's weakness reflected growing concerns about the health of the US economy and the potential for the tariffs to spark a global trade war. The stock market crash and the imposition of sweeping tariffs have cast a pall over the global economic outlook, fueling fears of a recession within the next 12 months. Economists warn that the tariffs, coupled with other headwinds such as rising interest rates and geopolitical tensions, could tip the global economy into a downturn. They argue that the tariffs will disrupt global supply chains, raise prices for consumers and businesses, and dampen business investment and consumer spending. Gregory Dacko, chief economist at EY, predicts that the tariffs will shave 1 percentage point off U.S. GDP growth in 2025 and 0.4 percentage points in 2026. He also expects consumer price inflation to rise by 1 percentage point by the fourth quarter of 2025, further eroding consumer purchasing power. The specter of stagflation, a toxic combination of stagnant economic growth and high inflation, is also raising concerns. Goldman Sachs, a prominent investment bank, has raised its probability of a U.S. recession in the next 12 months to 35%, up from 20% previously, citing the potential economic fallout from the tariffs. The escalating trade tensions have prompted comparisons to the disastrous Smoot-Hawley Tariff Act of 1930, which is widely blamed for exacerbating the Great Depression. While some analysts hold out hope for a market rebound by the end of 2025, the path ahead remains fraught with uncertainty for the global financial market. How will the Asia market react on Friday? That's an even bigger question.